All right, so with the Reserve Bank of India deciding to continue its pause on interest rate hikes, focus is back on home loan borrowers who have seen rate hikes in the last 1 year impact their home loan EMIs. But now that further rate hikes looks unlikely, at least in India, what are banks thinking about interest on home loans? We will see a reduction in interest rate for home loans going ahead. Let's answer all of these questions. We are joined by a panel of experts, Aparna Ramachandra, founder, director, rectifycredit.com, Chitrabhanu KG, SVP and Country Head, Retail Assets and Cards, Federal Bank, Abhinav Kaul, Vice President, Partnership, bankbazaar.com. Good evening and welcome to the show. And we are going to help our viewers, especially the ones who are really struggling and hoping that there is no further increase in the EMI. What should be the way ahead for them? So, Aparna, coming to you first. Repo rate unchanged at 6.5% yet again. This is welcome relief for home loan borrowers who saw a steep and big rise in their home loan interest rate with a span of, 10 months starting from May 2020 to Feb 2023, when RBI raised the repo rate by a total of 2.5%. Now, the question is, are the two consecutive pauses in repo rate hikes a signal for the end of the current rising interest rate cycle? Is there a chance of interest rate falling soon, or there could be a pause that we can see extending?
Hi, Kavita. Good evening. I am not going to get into the speculation as to what is going to happen, but I feel there is going to be what was going upward, I think, is now kind of here. So, if not this, at least here. So, let us assume for the home loan borrowers that they take this as their benchmark and plan their home loan decisions accordingly. So, I do not know whether, to answer your question, so I don't want to speculate. But I
The
would advise
discussion over
my
here,
clients
because
to take this as
so
a
we will just
benchmark.
hold that answer of yours now, because I really want to lay this ground and help our viewers understand what's going to be the trajectory. Although nothing can be decided, things are really unpredictable. But Chitrabhanu, what is your analysis to the same question that I asked Aparna? Chitrabhanu, are you able to hear me?
Oh, sorry, I just lost you. Can you just repeat your question?
Sure. The question actually is that are the two consecutive pauses in repo rate hikes a signal for the end of the current rising interest rate cycle? Is there a chance of interest rate falling soon, or the pause being extended?
I think that's the best guess for all of us. And that's what we hope, all of us hope for. Because one of the reasons why the interest rate was getting hiked, not only for housing loans, but across product lines, was because the inflation was going up. And we see that in the last few months, there has been some level of stabilization in the inflation rates. And we expect that the inflation should be at around 5.1% by the end of this financial year. So if we see that happening and a downward trend towards inflation, I'm sure that we will have the housing loan rates, all the other interest rates, etc., going down. That's something which the entire market is expecting. But again, as pointed out by the earlier speaker, we should not be speculating on that. This is something which we should expect and hope for.
But then how is the retail loan demand so far coming up? Is it still strong, or you've seen a dip in it?
Yeah, surprisingly, over the last 1 year, the overall demand for housing loans and in specific and housing loan in general, retail loans and housing loan in specific has been quite good. It has been quite buoyant in spite of the fact that interest rates came up by close to 2% over the past 1 year. So even now, during this financial year, overall, the demand for housing loans, the demand for the other retail loans has not been bad. It has actually matched the demand of what was happening the last financial year. So that's a very positive trend for all of us as bankers, and in that sense for the overall economy also.
Abhinav, what's the current strategy for all the home loan borrowers and people who are really struggling to, save the higher EMI amount? Because although it is a relief for now, but then how exactly are banks looking at it? Are they up for giving some kind of a relief? I think this question will be directed to Chandrabhanu also later on, but then after you, Abhinav.
Sure. Good evening, Kavita. So, what we've seen, like my fellow panelists also said, in the last couple of years, we've really seen, because of the repo rates going up, the interest rates have also gone up. in the last couple of policy decisions which have come out, the repo rate is flat. Now, the general tendency, and again, not speculating, but just from experience, what looks like that because the retail inflation is somewhere seems to be getting under control, not fully where maybe RBI would want it to be, but because there is some semblance of that normalcy coming in into that inflation, we've seen this repo rate getting stabilized. We may, if this trend continues, we may in the next 6 to 12 months even see it coming down, and with that the relief will obviously be there for the retail consumer as well. As for what the consumer should do now, uh, the welcome relief is that now that upward trajectory has kind of come to a standstill. For the next few months, we don't see this interest rate going up. And this again is like an individual decision. It basically depends on what is the stage of the loan of that individual customer, how many months on board are they, what is the kind of stress that they have felt, because EMIs have almost gone up by 15-20% compared to where they were 2 years ago. So there are multiple options which actually people can take up, like maybe refinancing their loans and going to other lenders who are offering maybe a smaller, a lesser spread. But again, even the banks are trying to do something from their end. So all the financial institutions and lenders, what we see is that they have kind of brought down their spread. So which earlier was roughly close to 3%, that spread we see is close to 1.9% or 2% today. So there is a collective effort from everyone, from the regulator, from the banks, and then obviously it's an individual choice of where a retail consumer is today in their journey on their home loan, that they will have to evaluate and move forward. Kavita.
How are you evaluating in your bank?
Sorry, I didn't catch that, Kavita.
So, Chitrabhanu, as Abhinav spoke about how each banker is trying to evaluate, what is the strategy now at your bank? Are you trying to give relief to all the home loan or maybe just loan borrowers?
See, there are two parts to it. One is on what do you call that? How do we ensure that the customer retains his EMI over a long period of time? So that's something we are supporting. Not only we as a bank, but I'm sure the entire institution supports the customers in that sense. So initially, what we have started off is when the interest rates increased, we increased the period of the loan for the customer so that his EMI is retained at that point of time. True, the interest rate would have increased, but the customer is benefited in terms of he having this to pay the same EMI at this point of time. That's something which we are doing. The second point is, the market is in that sense very competitive, and every bank has to live to that expectations of the customer. So sometimes we may have to look at some marginal improvements, but that's all dependent upon each bank. It depends upon what is his liability profile, what is his overall asset expectations, margins, etc. So it varies from banks, but it's been always that we'll have to live with the competition and ensure that we match, especially for a product like a housing loan. Every customer will look at what are the rates in the market available, and now it's much easier with having all these a lot of aggregators in the market. So it becomes much more easier to understand what are the rates which are better in the market, which is a better product available. Maybe a lot of banks have also offered products like uh, OD products, which is similar to maybe wherein you can, even if you have extra money in your hand, this is an opportunity for you to put some money and ensure that your interest rates are kept low. So these are all opportunities available with the customer and some things which the banks have also given to the customer.
All right. So, Aparna, HDFC Bank has hiked benchmark marginal cost of funds based lending rate MCLR by 5 basis point to 15 basis point with effect 7 June. The lending rates have been raised from 10 years starting overnight to 6 months now, which means those who have home loan, personal loan and vehicle loans tied to MCLR will clearly be impacted. I want you to explain this impact to the loan borrowers and also the difference between MCLR and EBLR rates.
That's a very good question. Most of the loans today are linked to MCLR. Even when the customer asks for a fixed rate of interest, most of the banks today do not give that option. So reality is almost 80 to 85% or even 90% of the loans are linked to MCLR. So now your repo rate, every time there is a movement there, correspondingly your rate of interest for the loans also fluctuate, right? So in the current scenario, The repo rate, RBI has managed to keep it at the same. It has not, tweaked it either upwards or downwards. So, which is where the home loan rates are going to be similar. So now we have two scenarios here. Every borrower that is linked to the, MCLR rates has an option to go back, and most lenders on their own are today talking to the borrowers and saying that in the next 2 months we are going to be reducing the rate of interest because the our borrowing costs are coming down, so you will also be getting a better rate of interest. In case you do not get that, is where you have to go in for your balance transfer and all of that. So most, what I would, why I'm bringing this topic is most of the uh, articles that came out online right after this 7th June meeting of RBI was, everybody said, oh, this is the right time for going for balance transfer. You should opt for balance transfer. See, balance transfer is not a blanket solution for everybody, number one. Number two, it is not a free of cost situation, because you may end up paying something like processing fee, again, documentation and all of that. Though if your existing lender himself is willing to, if they are willing to relook at your rate of interest and give you a better rate of interest, I would suggest that you are happier continuing there rather than go through the pains of shifting to the loan. Yes, in scenarios where your home loan is not getting revised to the reduced rate of interest, there you can choose to do your balance transfer. So for to come back to your question, every borrower today, wait for another month, talk to your lender, see what they are offering you, do your homework, and then go back. Today, 9.5 on 10, when you go and tell your lender that I have done my homework, these are my options, can you match this? Like my other colleague said, they are going to be relooking and trying to retain you, because customer acquisition is becoming more expensive. Customer retention is all the more dearer. So all the lenders are going to be looking at you differently. Kavita.
One more aspect to this, Chitrabhanu, let me come to you with this. Any further increase in policy rates means that interest rate on home loan may hit an all-time high and touch almost double digit. Now, we could have a substantial impact on buyer sentiments and affordability, which in turn can curtail demand. Are you prepared for this situation?
I think as bankers, we should be ready for that, because so though we all hope and pray that it does not happen, but in case there is again a chance that the inflations can go up, etc., then the RBI might look at even a further hike, which I hope at this point of time, in what we see in the market, it may not happen. But if that happens, in this scenario, the banks have to be slightly careful also, because you get a customer at a comparatively higher rates and the EMIs are comparatively higher. The risk on the bank is also in that sense increased. So what will happen at that point of time is we will ensure that we give customers only who require this for a final, for buying a house for his own living. Maybe the investment requirements, etc., might come down a little bit. So those are certain cares I'm sure the banks will anyway take. So yes, to make the story short, I think banks will be prepared for that, and we'll be slightly careful, because margin is in that sense very important.
Abhinav, we spoke a lot on home loan, but then what about personal loans and car loans, which are also on a rise as per the rising demand?
Right. So, see, overall, because of the repo rates going up, right, we've seen the entire gamut of loans get expensive. And like we've been discussing for the last 15 minutes, everyone is kind of now keyed in to see what is the next step, how does the inflation pan out in the next 6 to 12 months, what does the RBI further decide on repo rates, and how that trend line would be. See, once we see that stability, like I said earlier, in inflation, the repo rates are sure to come down. Overall, the interest rates across product segments will come down once this happen, be it a personal loan or be it a secured loan like a car or a two-wheeler.
So far it's a pause, but then going ahead, if you're a borrower, if you have any sort of loan, you really might consider at least the home loan. You might want to consider the balance transfer, refinancing your home loan. But then going ahead, it's good that if a loan borrower is prepared with the kind of expenses and their EMI planning. Thank you so much, all of you, for being on the show and helping our viewers with that today. On that note, we'll take a quick break, and post that, let's talk about your bond investment and how to make the maximum of the maturity period.